Welcome to Buy, Hold, Sell. My name's Matthew Kidman, and when you're playing the share market, you've got to be ahead of the fashion curve. If you're not in the most fashionable stocks, then you're going to struggle. And of course, you have to be in the right sectors. And some sectors are fashionable and others aren't. Today, we're going to talk about two such sectors. Mining services, you can't get enough of them. Discretionary retail, you want to put your clothes in the bin at the moment. 4 years ago, it was totally different. It was switched around. And if you made that switch, you've made a lot of money. To talk about this subject, I've got Andrew Mitchell from Ophir Asset Management.
Thanks for having me.
And Prasad Patkar from Platypus Asset Management. We'll start with you, Prasad.
Sure.
Let's go with mining services. Go back 18 months, no one wanted to know them. We're expecting them all to go into administration. Bang, things turned, and they've been some of the best performers on the market. Where do we sit now with that re-rating?
Yeah, I think that's exactly right. 18 months ago, they were all close to their near-death experience, I suppose. And the re-rate from that point to now is about them surviving and having delevered, as well as now starting to see growth in revenue and profits. So the question from here on in is how long does this prolong for? The duration is the question now. It's not about their survival or otherwise. So there's no such thing as easy money in any sectors really, but those that took risk 18 months ago against and bet against their collapse or the collapse of the sector more broadly have done really well.
Okay, Andrew, do we have to, under that scenario, do we have to be a bit more selective? 18 months ago, you could have bought anything, double, triple your money in that sector. Now, is it all about stock picking or is it over?
Well, I think the heavy lifting has been done, undoubtedly. They've been re-rated. What we're looking for now are the quality or the more quality companies that are on the maintenance replacement capital side of things, and we really need the upgrades to drive them further. The cycle's on their side, upgrade in earnings. The cycle's on its side. Some won't meet, others will ride the cycle and do very well. So you need those upgrades to come through.
So there's still a little bit there. Now let's flip to the other side, discretionary retail. The consumer feels a bit sick, doesn't want to spend her money at the moment. Which wasn't the case a few years ago. House prices down a bit. And of course, out there on the horizon, they're going to press the go button, I think, in the next couple of days, Amazon.
Yes.
It's all threatening, it's all scary, but there's a lot of cheap stocks out there. How do you see the sector?
Yeah, again, I think it's to the point that Andrew just made, you have to be selective. There will be retailers that will survive the Amazon threat, the downturn in the consumer and the works, and they will come out on the other side stronger. The question is which management teams have the mindset to make the transition. And it's not an easy one because in making the transition and accepting the threat from the likes of Amazon, you're in effect disrupting your own business. I mean, it wouldn't be acceptable. I wouldn't have thought anyone within Myer if they were to think, and I'm making some numbers up here, but if they currently have about 60 odd stores and their business in the future, for an Amazon-proof future, if you will, should be 12 stores. Would that be acceptable? I mean, that's the mental transition that retailers have to make, and it's not an easy one. Big
change. So we've had the nuclear bomb dropped, and there's a few cockroaches that have crawled out of it. What are those retail stores that will survive? Well, I think the Amazon bomb.
We're looking for one. You don't have to have companies that are leveraged to Amazon. Companies like Livewire, which is affordable luxury that really cannot appear or be very hard down the list in terms of Amazon, what it disrupts. We like the retailers with strong store rollouts still that aren't as affected by Amazon, and you can still take market share and grow in this really tough retail environment that we're in.
Okay, on that theme then, do stocks that or companies not affected by Amazon or less affected go to a premium to what they used to be?
Well, I think at the moment they're coming down. So the market, and that's the opportunity, right? Because everyone's worried about Amazon. Retail is very tough in Australia. You've got zero wage growth and the likes. But it's dragging the whole retail sector down. There are stocks there that should be trading on a premium that are just getting dragged down. We need to look through the clouds, find those companies, and this is a great time to invest. The market will look through eventually, it always does, but at the moment, this is where the opportunities come.
All right, Prasad, here it is. Where are you going to put your capital? Are you going to buy those more expensive mining services companies that are flying at the moment, or are you going to get the cigarette butt and try and smoke it with the discretionary retailers?
Well, fortunately, we don't think about investing in those terms. We do really focus on bottom-up stock picking. And in sectors that are totally in favor, you can step on landmines. And sectors that are completely out of favor, you'll find gems if you take that approach. I mean, the case in point is the profit warning from Maca last week. I mean, it's a mining services company and had a massive profit warning. So you can stumble in the more fashionable sectors as well. So stock picking, getting the earnings right, And then, as Andrew said, looking through some of these short-term risks and concerns in the market will eventually pay off.
All right, one more question on that then. So which sector is going to give you more gems, do you think? What's your gut feel? If you're going to do stock by stock, which sector is going to deliver the better?
I'd go for some of the consumer discretionary stocks, really, which look like there's more opportunity there than there is probably in the mining services sector at the moment.
We don't want to get our hands blown off by downgrades, especially when stocks are expensive. So which sector do you think? The mining services, good momentum?
I think
we're
less so going to see downgrades in the mining services sector just because the cycle's behind it. But retail is where the really cheap stocks are, the ones where the market has really little in the numbers for those companies. So that's where you're going to get your biggest bang for your buck at the moment.
Sounds like it's fashionable, believe it or not, to go shopping again. And so you've got to pick the right shoes to wear in this type of market.